You have 1 crore rupees to invest in real estate. Option 1, buy REITs and collect dividends. Option 2, put it down on a rental property and become a landlord. By the end of this video, you'll know exactly which option can make you more money and why most investors get this decision completely wrong. I'm Dipom and I've analyzed hundreds of real estate investments. Here's what I've learned. Most people think rental properties are always better because you own something physical, but when you actually run the numbers, the results might surprise you. Today I'm going to show you a side-by-side comparison using real numbers, real costs, and real returns. But first, let me explain what REITs actually are, because many of you might be hearing this term for the first time. REIT stands for Real Estate Investment Trust. Think of it as a mutual fund, but instead of investing in stocks, it invests in real estate. So when you buy REIT units, you're essentially buying a small piece of multiple commercial properties. Here's how it works. A REIT company takes money from thousands of investors like you and me and uses that money to buy office buildings, shopping malls, hospitals, warehouses, and other commercial properties. These properties generate rental income, and that income is distributed to REIT investors as dividends. In India, we have different types of REITs. Office REITs, these own office buildings and IT parks. Retail REITs, these own shopping malls and retail spaces. Healthcare REITs, these own hospitals and medical facilities. Industrial REITs, these own warehouses and industrial spaces. The most popular ones in India right now are Embassy Office Parks, REIT, and Mindspace Business Parks, REIT. REITs make money in two ways. First, rental income from properties. This is distributed to you as dividends every quarter. Second, property appreciation. As the value of underlying properties increases, the REIT unit price also goes up. Here's the beautiful part. You don't need 1 crore to start. You can buy REIT units just like stocks. Minimum investment is usually around 15 to 20,000 rupees. Compare this to buying a rental property where you need at least 50 lakh to 1 crore for a decent property. Now let's start with our scenario. You have 1 crore rupees. Here's what each option looks like. Option 1, REITs investment. You invest the full 1 crore in dividend-paying REITs. Current average yield in India is around 7 to 8% annually. That's 7 to 8 lakh rupees per year in dividends. Option 2, rental property. You use 1 crore as a down payment on a property worth 3 to 4 crores. Let's say you buy a 3.5 crore property in a good location. You take a home loan for 2.5 crores at 8.5% interest. Now let's talk cash flow. This is where things get interesting. REITs. Cash flow. Annual dividend 7.5 lakh rupees. Monthly cash flow 60,500 rupees. No maintenance, no headaches. Money hits your account automatically. Rental property cash flow. Let's say you rent the property for 60,000 per month. That's 7.2 lakh annually. Sounds good, right? But wait, your EMI on 2.5 crore loan is around 2.3 lakh per month. Hold on, that's already more than your rental income. You're actually paying 1.7 lakh every month out of your pocket just to own this property. This is where most people realize they made a mistake. But let's assume you found a property that actually generates positive cash flow. Maybe you rent it for 1.2 lakh per month. Now you're making some money, but let's see what's left after all expenses. Here are the costs nobody talks about when they say rental property is great passive income. Monthly expenses, property maintenance, 5 to 10,000. Property management, 8 to 12,000 insurance, 3 to 5,000 property taxes, 2 to 4,000 vacancy allowance, 6 to 8,000 repairs and upgrades, 5 to 15,000 per month average. That's 29 to 54,000 in monthly expenses. And this assumes nothing major breaks down. Now let's talk taxes, because this is where it gets really interesting. REITs taxation. Dividend income is taxed as per your tax slab. If you're in 30% bracket, you pay 30% on dividends. Clean, simple, predictable rental property taxation. 30% standard deduction on net annual value for repairs and maintenance. Home loan interest can be deducted under Section 24B. But here's the catch. If your property appreciates, you'll pay capital gains tax when you sell long-term capital gains, 20% with indexation benefit short-term capital gains, as per your tax slab. This is huge and most people don't think about it. REITs liquidity. Publicly traded REITs are far easier to buy and sell than the laborious process of actually buying, managing, and selling commercial properties. Sell anytime during market hours. No paperwork, no legal hassles. Money in your account within 2 days. Rental property liquidity can take 6 months to 2 years to sell. Legal paperwork, registrations, approvals, brokerage fees, legal fees, stamp duty, market dependent. In a down market, you might not find buyers at all. Let me show you what happens over 10 years with both investments. REITs, performance. Initial investment, 1 crore annual dividends, 7.5 lakh, assuming 7.5% yield. Total dividends over 10 years, 75 lakh. Property value growth. REITs have historically grown 8 to 10% annually. Estimated portfolio value after 10 years, 2.2 crores. Total returns, 1.95 crores. Rental property, performance, initial investment, 1 crore down payment. Net rental income after all expenses, let's say 3 lakh per year. Total rental income over 10 years, 30 lakh. Property appreciation, 6 to 8% annually. Property value after 10 years, 6.2 crores. Outstanding loan after 10 years, 1.8 crores. Your equity, 4.4 crores. Total returns, 3.7 crores. Wait, so rental property wins? Not so fast. Let me show you what this analysis misses. Time investment. Rental property requires 5 to 10 hours per month managing, dealing with tenants, maintenance, repairs, legal issues, vacancy periods. That's 600, 1200 hours over 10 years. Risk factors, tenant defaults, property damage, area development issues, interest rate changes affecting your EMI. Opportunity cost. Your 1 crore could have been invested in other assets. Market fluctuations affect property values. Rental yields might decrease over time. Here's something interesting. The best strategy might not be choosing one or the other. Let me explain. What if you did both? Use 50 lakh for REITs and 50 lakh as down payment on a smaller property. This way you get steady dividend income from REITs, potential property appreciation. Risk, diversification, reduced time commitment. Choose REITs if you want truly passive income, you prefer liquidity, you don't want to deal with tenants, you want to diversify across multiple properties, you value your time. Choose rental property if you enjoy being hands-on, you want maximum control, you are comfortable with illiquidity, you have time to manage properties, you want leverage benefits. For most investors, especially beginners, I recommend starting with REITs. Here's why. You get exposure to commercial real estate without the headaches. You can start with as little as 15,000 rupees and build your portfolio gradually. Once you understand real estate markets better and have more capital, then consider direct property investment. So what's your choice? REITs for passive income or rental property for hands-on investment? Comment below and let me know your strategy. If you found this comparison helpful, hit that like button, and if you want more detailed investment analysis like this, make sure you're subscribed because I break down complex investment decisions every week. Remember, there's no universal right answer. The best choice depends on your personal situation, risk tolerance, and investment goals. But now you have the real numbers to make an informed decision. See you in the next video where I'll show you the psychology behind dollar cost averaging and why your brain might be sabotaging your investment returns. Keep building wealth, keep staying smart.